Good morning.
How's
Morning.
everybody doing?
Good, good.
Good, good. Tina, welcome to the call. This is our Wednesday hero and superhero coaching call.
Awesome. Thank you for including me.
Yeah, of course. And welcome, Ernie. Welcome, Marty. Ernie, are you gonna have to go pretty quick? Do you have something you needed to talk about first?
No, I should be all right. I'm just working a off-duty job, but I'll probably eliminate my camera here
Yeah, no worries. Well, if you
if
gotta
I
go,
can
I
figure out
understand.
how.
But if you
Perfect.
need to, if you need to catch me on something and tell me I'm doing something wrong, I need to do it differently. I will sure listen today.
Excellent.
Oh, it's pretty cool to see your uniform. Welcome. Hey, Angela. Hey, John. Well, so the way this coaching call works, it's just open space. So we talk about reverse mortgage stuff. Mostly, somebody will have an idea of a question. I know Tina, you're on here today. You have an actual situation, and so sometimes I'll answer, and sometimes other people will participate too. And so it's a really nice way to get lots of different brilliant minds on the same topic, and different experiences. So I will actually let you go first, Tina, because I know you have a situation you wanted to talk to everybody about. Well, me.
Yeah, and that is super helpful because I would love a variety of suggestions because there might not necessarily be one right answer. So I haven't done a ton of reverse mortgages. I've kind of come close several times where I've done consults, gotten them numbers, and then they've backed away. So I'm feeling pretty confident with kind of, pulling together the information, doing the initial consult with the client, which I've done. I have a lady that's 82, her husband's 83. They want to do a reverse mortgage. And my question is this: I've gotten two quotes so far, one from Plaza and one from SmartFi, maybe. And I've talked with both AEs about it. But my question is this: I know that interest rates definitely affect what amount the borrower can have access to. But what I'm struggling with right now is finding some modeling tool because none of us have a crystal ball. We all know that rates are high right now, and we can all anticipate that rates are going to come down at some point in the future, whether it's 12 months, 18 months, 24 months, I don't know. But what I'm concerned about right now is putting this lady into a reverse mortgage right now with a really high market interest rate, knowing that I'm likely going to refinance her down the road and not having access to maybe some modeling tools where I can assume, like right now, the rate that we're working with is like 6.5. What happens if that comes down to a 5.5 or a 5? Right? I don't know how long it will take to get there, but I actually think in my gut, maybe we settle into the 5s, right, for interest rates, somewhere in there. I don't think they're going to be 3s again, but I don't think we're going to stay at 8s either. So I'm trying to kind of play with some modeling numbers, and both of my account execs have told me that there is no real way to do kind of some modeling of what would the net and the amount look like available to the borrower, assuming a different interest rate than par market interest rates today. Because I feel like if I'm thinking high likelihood of a refinance, I need to factor in the difference between the potential increase in a lower rate environment in 12, 24, whatever months. What's the difference in that potential net at a lower interest rate versus having her wait? Because between here and there, I have the cost of a refinance. And if the gain is not that great for making her wait, then maybe it's not worth waiting. Both account executives, when I started posing this question to them, were like, okay, great question, right? You're being really a thoughtful fiduciary, or right, asking those right questions, but we have no real way of modeling. And both of them are like, oh, you should do it right now. Have her do it right now. I want to hear from servants, right, in this industry, that really that is the best advice. And I understand the concept of this is an adjustable rate mortgage. So that rate is going to lower over time. But then it kind of got me really hung up and confused. And I wanted to hear it from the group. If the product is an adjustable rate mortgage and rates lower in the future, why would I ever want to refi her? So that's my question and conundrum.
I am so glad you brought that, Tina, because this is one of the mindset shifts from forward to reverse. And you're like right at the precipice of it. So thank you. Everything you've laid out is absolutely true, right? We know that when rates are lower, they get a larger loan amount. The thing we don't know is all the variables that create the PLF. We can't predict. It's easy enough for a regular mortgage to say, you know, your mortgage is 400,000 now. In 5 years, I'm going to do the math. It will be at 368. And if interest rates come down, then this is what we're going to be able to do, because you're only really working with 2 variables, maybe 3 if you have to worry about the LTV and the property value. But in a normal mortgage, you're not really having to worry about that. It just gets better, right? You know, the LTV is going to get better over time. In reverse, we've got many, let me list them out. I don't know how many, I didn't think of that. So we have the variable of the home's value, the people's age, the reverse mortgage balance growth over time, or not, right? They could make payments and that would affect it. The line of credit, if they have one, that growth rate, and then also the variable interest rate, right? Or a fixed interest rate. Like some reverse mortgages are still being done on fixed. It's just few and far between. So the way I want you to kind of look at this is, aside from the interest rates, what other decision factors are happening? Now, I'm not going to ignore the interest rates, but that's the main thing. Is there's probably some reason she's looking at a reverse mortgage. And if the opportunity, like you have a window right now, right? It works. The numbers work. That window changes all the time. So a story I like to tell is that I had a client in 2019. We looked at her numbers. She would have had to bring in 120,000. 2020 or 21, I think it was a year and a half later, she came back and said, I know we didn't move forward, but like, I really do want to do this reverse mortgage. You know, how much do I have to bring in now? And she didn't have to bring in a dime. In fact, she got 7,000. So the numbers swung by $127,000 because her property value went up. She was a year older, interest rates plummeted. And I think they actually changed the program guidelines in that time period too. The MI might have changed. And so the advice that you're getting from AEs is not incorrect. It's very common in reverse. If you can get this thing, get it, because the opportunity may go away. And the opportunity for refinance is awesome, because what can happen, in 2019, 2020, we refinance reverse mortgages that we never expected we would, right? You put somebody in a reverse mortgage at like 4%, you think that's an amazing loan. Well, what happened is property values skyrocketed. So we had so much more equity than was anticipated, than the formula calculates for. Interest rates plummeted. So suddenly the loan amounts just grew a whole lot. And then also people had gotten older. So like that doesn't typically make much of a difference. But the main 2 factors, the property appreciation and the interest rates, made this window just get huge. Well, right now the window's pretty small. If interest rates keep coming up, the window is going to keep getting smaller. If her property value declines, the window, it could pass, right? You could get into the negative. And so when you're talking about refinance costs, the majority of the HECM to HECMs I did, this is not true for every originator, but the way I teach, the way I believe, let me let Eric in, sorry about that. The way I teach, the way I believe to do reverse mortgages, why would you have them pay closing costs again when they already paid a decent amount? And so when it's possible, and most of the time it is, not always, but most of the time it is possible to make the refinance a zero cost to them anyhow, other than the cost of counseling and the cost of an appraisal and government recording charges. So like, keep the whole refi cost very, very low. The MI gets credited. So they're not going to be paying MI again.
Okay.
If the variables don't work out perfectly, there's a chance they may pay some portion of MI, but most of the ones I did had 0 MI. They got a full credit. So then we go back to, okay, that's how it's wildly impossible to predict what the refi is going to look like if you're going to refi. And you hit the nail on the head too. So does this client have an LOC, a line of credit available?
Yes, after year one,
Okay.
is that what you mean? So she had available like somewhere around $60,000 as her initial year one. And then after year one, she had 213 or 220 or something. I'd have to pull up the quotes.
Oh, it's big.
So she
Okay.
had 200 or so $1,000 available after year one.
Okay. So then my question to the client would be, is that sufficient for what you want and need today?
It's really not. And that's kind of where the conundrum is she was thinking she probably needs like 80 grand up front year one. She wants a new car. She needs to do a roof. She blah, blah, blah. Right. So she's thinking she needs about 80 year one, which then started me going down the road of maybe I just need to do a home equity line of credit on her for this year, right? And see where rates go. But then, like you're educating me, the window for doing a HECM may not be there in the future. So,
well, and are you taking a mortgage payment away?
no, but
She's
her
free and
mortgage
clear.
payment is literally $985 plus taxes and insurance were fully burdened $1,700 a month or so.
Okay. Well, she still had the property tax and insurance, but let's go 12 times 900-ish.
Yeah.
That's another 10.
985.
That's another 10, almost 11,000. So you've
Yeah.
got her to 71,000.
Okay.
Is she going to say no over 9,000? And if so, maybe you got to work with Elaine to figure out how to bring your closing costs, bring the margin down to give her that little bit of room. You're in like really good numbers right now. Sometimes we talk on these calls and I'm like, sorry, there's no hope for this client. It's not going to work. You are right in the range where if you're able to lower the origination dollar for dollar, that'll take up what she can get. I mean, first year versus second year. But realistically, these construction projects and everything take time, get $60,000 worth of the things done in year one and finish up the last 20,000 in a year.
Yeah.
All while having no
does
payment.
have some savings, right? She has some liquid savings. I just yesterday got her asset statements, taxes, and her Calster's retirement and his social security statement. So I kind of needed to take a look at all of that to be like, okay, how much are you really spending per month? How much are you bringing in? How much of a bridge do you need every month that you're not using? How much is in that retirement account? And so I kind of just got all of that information yesterday, but she is wanting this. I think they need it. They're not going to make it into retirement without a reverse mortgage. I'm just wanting to make sure that it is enough and that I'm not leaving, and I'm still not understanding, and maybe you can explain this one more time. Like, if you do a refinance of a reverse mortgage at a future point in time, what does that do to year one availability and line of credit after year one?
You're pretty much up against the same formulas. It just matters how the numbers are going to work out. So we have, if she takes the full 60% in this year and then refinances and somehow the numbers work that she's still at 60% to pay off that mortgage, which, that's not that realistic that would happen. But if it did, let's say we take her to the 60% with the mandatory obligations, which is the loan we're paying off, all the fees, any liens against the property, that mandatory obligation bucket right up against 60%. Now she gets an additional 10% of cash. The formula is real funky. And when we're right up against the 60% rule, by mandatory obligations only, right? Not cash being taken, but say the mandatory obligations get her to 60%, then they'll give her an additional 10% in the first year. And then what would that be? And a remaining 30% is held to the second year.
Mhm.
So realistically, if you did refi her, she took all the cash now, waited however long, over a year at least. Some lenders
Mhm.
require 18 months.
Mhm.
Then you could get her another 10% then first year. But at that point, would you even want to? Because she's got this line of credit that has likely grown pretty large because interest rates are high right now. So that's the other benefit, is it's like never the wrong time to do a reverse mortgage, because either rates are low and you get a lot, or rates are high and your line of credit is going to grow a lot. When rates are
Okay,
low,
say that one more time, just so I can digest that. So when rates are low, she can get a bigger upfront, but less for the line of credit.
less growth over time for the line of credit, because the line of credit grows at the interest rate.
Okay,
But when rates are low, they get a larger amount up front, and then the line of credit doesn't grow that quickly. So likely, if you're placing her into this today, the line of credit is going to grow pretty big. When you look at refinancing, there's a lot of quotes I see where I'm like, no, we can't beat that line of credit. It already grew too fast, too big. What I can do today won't compete with that.
okay. And as interest rates go down, though, doesn't that line of credit get readjusted lower at the lower interest rate?
Yeah, the line of credit, the growth rate adjusts with the interest rate. So if you've got a monthly, it's going to adjust. If you got an annually, it's going to adjust down. But if by waiting, you're missing the opportunity for that large growth, right? Because what's the rate you're looking at for this client?
6.5, I think.
So for however long, she's going to get a line of credit that is growing at 6.5. If you wait, she'll get a line of credit that never had that opportunity.
Okay, so the line of credit is growing at 6.5 for at least 18 months, right? Like 12 to 18 months.
Not necessarily. It's going to depend if it's a monthly.
Oh, because it's going to adjust monthly.
Yeah, if rates drop to 3% next month, she'll feel that. That will happen for her loan if it's on a monthly adjusting.
Okay, so, and if it dumps, then she's already, if it dumps, the interest rate dumps in 3 months. I'm not saying that I think that's likely, right? But if for some reason the interest rate did dump in 3 months, basically what she left on the table by waiting, right? I mean, there's just no way to time this.
You got it. I mean, for clients who the numbers don't work, you have to wait, right? And we just kind of hope and pray.
I have one of those right now too. So I have one of those right now too, that the numbers just didn't work even with her bringing stuff.
Yeah.
So,
all right. It sounds like Cicely, you've got something to say.
I just want to say that I had a client last year that just had to have a HELOC because he just needed money and didn't want to wait for the reverse mortgage to work. Now he's eligible because the HELOC the 12 months has passed, but his HELOC payment has gone up $400 a month, went from $200 to $600. He can't really afford that now, but because the interest rates have gone up so much from last year, the reverse mortgage doesn't even work anymore, even though the value of his home has gone up and his age has gone up. But because of that HELOC, we can't even do it unless he somehow finds a way to pay off that HELOC. So I just feel like, why not now? If they want it now, because you don't know. He didn't know. I mean, if he had known that the HELOC could go up another $400 a month, I think he would have been like, okay, maybe I don't need to spend so much right now, or whatever his thing was. And I mean, is she in a dire need of getting a car this very minute? Can't she wait till and that's available later?
Well, and what I'm gonna ask her also is, right, she has 150,000 in a retirement account or whatever. So if she's able to get 60 this year or whatever as her year one up front, why not take that, get the roof, buy a car for whatever, 45 or 50, and maybe need to use some of her savings, because then in month 13, when she has access to year 2 money, she can always take a little and repay that savings account if she needs to. that was the other strategy that I was thinking of, to make sure that she at least got what she needed. And I appreciate you pointing out, Christina, that she's also getting basically the equivalent of another 10 grand because she's not making her mortgage payment or the principal and interest portion of the mortgage payment. So that's helpful too. And that's something that when her and I sat down yesterday, that I think I wasn't capturing yet, and I needed more time to really digest this as an option for her to figure out how I can make it work.
May I make a suggestion?
Yes.
This is Erica. You can because when we're, I don't know about you guys, but when you're looking at trying your best to look at all the pros to educate the client, like you said, you couldn't wrap your head around it, all the benefits. You just know that it's a benefit, but you're trying to communicate it to her, right? I would sit now, like after this conversation, and just kind of bullet point all these things for yourself so that you can kind of rattle off, like, listen, I sat and I looked at your situation, and this is what I'd like to recommend to you, and why. This, you're going to save here, so that's going to help us here. The line is growing because the rates are higher. We always have an opportunity to refinance when hopefully in the next year and a half or so, economists are predicting rates are going to be lower. That will hopefully also get you more additional money, but we can't, that's a future thing. A lot of people, when they look at HELOCs, they see those teaser rates.
Yeah.
That let the client come in. And so they don't realize, that they're only getting that for a year. They think, oh, it's okay. And they think it's all right, I'll pay that out. They have different perceptions or whatever. A lot of them think that they're going to be at that teaser rate. And now rates are higher. And now these rates are jumping, like you said, to 9%, and they can't pay it. And they've lost the opportunity. So I would use Cicely's example. One of my colleagues has a client right now that they're trying to help because he did, I would use that. And I don't want that to happen to you. So I think we can make a strategy here, a plan for you here. And this is what I think we should do.
Yeah. Okay. I think that's good. And I think that she actually is looking for that kind of guidance. But like you said, I kind of needed to come back to my office and really write down, this is how much you're getting for retirement. This is how much the husband's getting for retirement. This is how much you can get. Here's how much we think the car is going to cost, the roof, right? I just had another client do a roof recently by her. So here's how much a recent roof was. Let's look at that. Let's look at no monthly payment for mortgage, for principal and interest. Let's look at what your new monthly budget would be. And then after year one, right, we can supplement with some savings and then pay back the savings after year one if we need to.
Or what if they just make a car payment for a year with the money they're saving on not paying a mortgage?
Yeah.
And then they don't have that huge chunk of money going out. And that could be in their line of credit growing as well.
Well, and that's kind of why I'm so appreciative of this group, because those little things, right? Like I think I'm going to have to go through a couple scenarios like that and say, okay, if we did make a car payment for a year, what would that amount be? Right? You're not paying $985 for principal and interest anymore. What if we're paying a car payment of $600? You're still $400 outright, and we didn't have to draw on $50,000 cash out. Right? That might be a smarter way to go about it. She can still draw some of the 60 grand, but she doesn't need to necessarily go out and pay cash for it.
Yeah, you have to help her stagger out what's more important, because you're still, that's the beauty. That's where I would sell the excitement of the reverse. That's the beauty of the reverse. It's allowing you to do some of these things without taking the financial hit. Yeah,
absolutely.
You're just rearranging. We're just playing with the money that you got. We're playing with these buckets.
Yes.
We're playing with the buckets, and how do you want to manage? What's important to you, Mr. Customer? I think that roof is important, right? I think we could still do a car. You might even still be able to take some of the money and put a down on the car and she still have a less payment.
Yeah,
Because now you have no mortgage payment.
yes.
So there's a lot of ways that
absolutely.
there's a lot of ways that you could spin that.
Yes.
It's just what she needs is confidence in you and confidence in the plan that you are bringing to her.
Yep. And I think typing it
And-
out and giving her those numbers in front of her will be
Mhm.
the answer to all of this. Let me come
I
back
would,
to-
I even do like a little illustration sometimes. I haven't done it in a long time, but you're just bringing it back to me. I need to do this to a customer myself. So these calls are great because it makes us all think about things. But you can even draw on a paper like buckets.
Yes.
So, okay, here's what you got. 150,000 in this in your brokerage account. You know, what's that growing at? You know, look
Yeah.
at that. What is that 150 growing at? So that, you
Yes.
know, because that's also another thing that we try to, you know, we're trying to get business from financial advisors, right?
Right.
And, you know, the financial advisor doesn't want her to withdraw from that.
No,
You know?
absolutely. Let me
So,
come back to Christina's comment about working with someone to lower the closing costs. Could you talk to me about that also?
Yeah, so before we get there too, I think you should run this scenario through Heckam Hero. I've just
Okay.
put Jessica's link. Jessica does demos. So if you coordinate a time with her, then tell her the inputs, run it through Heckam Hero and just see, because the graphs that it puts out for the line of credit growth, I think may be really powerful to help her understand this here.
Okay.
Okay.
Yes, that's good.
As far as the closing costs. So depending on the market, right, our pricing also changes. There have been times in the past where a Heckam, loan amount was 300,000. That Heckam, and depending on how you structure it and how you price, but competitive rates would have paid like 18 to 26,000, depending. You don't need 18 to 26,000 on every commission that you do a reverse mortgage on, especially if it's a refinance, especially if you're trying to help the person get a zero cost. And so what you can do is apply some of your comp to their closing costs.
Okay.
And in the proprietaries, there's some that have a lender credit option from the lender on the fixed rates. And so that's how you bring down most of them. The other part is the MI. The MI is the big closing cost, but they get a credit towards that. As long as you're doing Heckam to Heckam, if you're doing Heckam to Jumbo, like what's her property value today?
1.2 million.
Have you looked at a Jumbo no, because you said Plaza and SmartFi. Did SmartFi run it on the Jumbo?
No, because both of them told me that I was capped at the 1,083,300.
For a Heckam.
Yeah.
For a
So
Heckam,
both
but if
said
she's looking
any
for more
value above that, because she could be 1.1, she could be 1.2, right? At this point, when I'm trying to squeeze every dollar out of it, the difference in that $100,000, I was thinking was a bigger deal. Both of them explained the same thing, that anything after the 1,083,300 or whatever that number was, you aren't getting credit for that additional value anyway, because FHA is capping the value at whatever FHA's value is.
unless you switch to a proprietary. But if it's only 1.1, the LTVs on the proprietary are so much lower, it's not going to make up the difference. If you
Okay.
had said like 1.8, I would say run it on a proprietary and see if they can get more.
Okay.
The benefit there would be we don't have this 60% rule. So the proprietaries are beneficial for that, and it may bring down the total. So like 60 plus her 200, say she's got 260 total. Maybe it brings it down to like 230 or 220, maybe lower. I don't know what the program is going to run today, but it's all available now. So
And one of them did give me a column for that as an option. And I think it gave her 386,000 available. Right. But that's significant. But she got to a bigger number on her line of credit. And if she's expecting to live long, then it's better to milk off that line of credit that's going to grow.
you got it.
right?
Yeah. And that really is looking at the client's long-term best interest rather than just what they're saying they want today.
Yeah. Yep. Okay. Thank you guys. That's great. Really, I needed that conversation and that input from all of you. So thank you for those little tidbits because that really help.
Where's the house located?
In Ojai, California,
How's the population of Ojai right now? Is it decreasing like the rest of the state?
no, because I'm in a tourist area that's high dollar. So no, we're in a tight little small community that is known by LA and New York and movie stars. And lots of people want to live here.
Okay.
How'd you like that earthquake?
They were centered here at my house, literally.
I know
like,
that.
underneath my living room, it felt like.
Yep.
It's been crazy. And
Of course.
that was not even crazy. The aftershocks have been
Yep.
gnarly.
And
So-
nonstop too.
Yes.
So what has happened with the value of your house over the last 2 years?
Gone up quite a bit.
It has.
Yeah.
And you expect that to continue?
Yeah, maybe it's starting to soften a little bit. In certain segments, like if you had a house to sell that was a starter home, those are 600,000, maybe $700,000. You could sell those in like 42 seconds. If you're trying to sell something that's in the $1.7 million range, which is kind of a lot of move up homes, the next
Right.
tier up, those are starting to sit a little bit.
Well, of course, that's part of the equation, right? If the value of the home does not continue to increase or decreases as the inventory increases, that's also going to put her in a different position. So if you can detect a slowing in the market over the last couple of years, like 2 years ago, it went up by 20%. Last year, it went up by 6%.
Yeah.
We don't know what's going to happen in the next year. If you wait, this could also be part of the contribution to changing the whole formula for you and not in a good way.
Mm-hmm.
It could, may not, but this is something else where, if you wait and the value does not increase or it even decreases over time, this is also going to have a negative impact on your initial draw and your line of credit in a year.
Yeah.
Because rates are going up. As rates continue to rise, and we expect them to rise again in September, as they continue to rise, demand for homes is going to continue to decline. People just can't afford them.
Yeah.
When they're at 8%, 8.5%, the inventory is going to increase. So it's something to consider along with all the other points that have been discussed. Is the home value itself, where is it now? And what does your crystal ball tell you? You don't know.
Yeah.
You have no idea.
I have a cloudy crystal ball on my desk just for
That's
that
perfect.
purpose. It's
Yeah.
cloudy. You can't see, not in reverse.
Yeah. 2 years ago, you would have said, oh, house values increase 20% every year. Well, here we are, and the rate is almost 8%, and it's going to be over 8% in September
Yeah.
when the Fed gets stupid again and makes stupid comments and raises it another quarter point.
So
Yeah.
Tina, I want you to just take a moment and just soak in that you're talking to people who have had the devastating experience of having a client that could do it and they chose not to for whatever reason. And then they came back and said, yes, I do want this thing now. And they couldn't
Mm.
get it. And so the way I look at it is it's good today. It's not going to be bad tomorrow if you do this thing. There's no downside. The
Okay.
downside is just maybe there's a bigger opportunity. It could be even better tomorrow. And then we can refinance you into that even better situation. But even better than that is your line of credit has grown to an amount that I can't even help you refinance. Like
Yeah.
it wouldn't make sense. Your line of credit is huge. Good job. Pat yourself on the back. You've got the mortgage, the best mortgage you could be in. So it's good or even better
Yeah.
is don't do it. And now it's just open. It could be not possible. It could be awesome, but there's not a real good reason. Let me say it this way. The risk for the upside does not at all compare to the risk for the downside.
That's the answer I was looking for. That's why I called and reached out, because I was like, that's kind of what I needed to know, right? Like I can see closing costs are whatever. I didn't know that we could try to minimize some of those, right? Obviously, I would if I have to refi her. So many tidbits of great information that really have been super helpful so that I can confidently establish a plan for her, which I think I can. I like the idea of possibly financing the car and letting the additional money, or doing a split of that, maybe only taking $25,000 or $30,000 of the 60 and letting the additional amount appreciate at this higher interest rate that we're in, so that her line of credit grows even more. Because I think that's probably the smarter way to go about it.
Awesome. Awesome.
Yeah.
Well, thanks for bringing that. I think we all learned
Yeah,
a lot.
thank you. That was a
robust-
great discussion. I appreciate it.
Quick
All right.
question on this. Are you just having them run your scenarios, or do you have quantum or reverse vision?
I have quantum reverse is what I
Okay.
have, but I have my account executive run through the scenario. After I get the information from them, I've called back and said, okay, let's make sure I totally understand this. So yeah, both have been pretty knowledgeable and shared different bits of information.
So I'm gonna make a suggestion. If you're in here, I'm assuming that you have access to the classes. Take the time, go through the master class and all that stuff, and this will get easier when you're doing it yourself, because while they know what they're doing and they're helpful, they don't have all the little ins and outs that you'll see once you start messing with it. And depending on where you work or whatever else, you can change margins yourself with a click of a mouse and see if that's enough to help the deal, or and then look at different comps and all that stuff. So once you get further into this, you're going to see you're like a wizard compared to them. You can make this happen without having to wait for phone calls or please try this, try that. You can do it all yourself, and
Okay,
it'll make you way more effective.
thank you.
You're welcome.
Thanks, Artie. Great point. Yeah, Tina, that a little tough love, but yeah, there's a higher level, and you're so smart. I know that if you invest in that, you'll be a whiz at it. You can
Thank
schedule with Elaine too. She helps you actually in those systems.
Okay.
All right. Very cool. All right. What else do we
Chris-
have for today? Yeah, go ahead.
I have a couple, but something that hit me that you said that maybe throughout this entire time I've been misinformed about is, let's say, we set somebody in at 7.5% right now, and then it's a 5 cap, so it goes up to 12.5. It's always been my understanding that 7.5 was the floor. And maybe I misunderstood something that you said, but if the rate drops to say 4, does it actually go through the floor to 4, or?
I'd have to check on if there is an actual floor on HECM right now, because the way it's worked in the past is it just keeps riding down. So like
Really?
in 2019, sometimes I would get a mortgage statement where the margin, they had given them a really good margin to begin with, and now that rates had dropped, I couldn't compete at all. Like I was seeing statements with like margins or interest rates in like the 1.95 range. Like
Wow.
it was insane. And it's because they do ride down. Now you're probably thinking of the jumbos. The jumbos pretty much whatever the rate is on the ARM jumbo today, that's the floor. So most of the time it's 499, 599, 699. That's the floor on the jumbo ARM, and it won't go below that. It'll just go up. But the
So
HECM
then-
will actually ride down.
So Heckam to Heckam refi, the real gain to that is just the more principal limit if they need it. So
The more principal limit, and 2018, 2019 was a time frame where the whole industry used to do annual adjusting rates. And the
okay.
industry had changed where investors no longer wanted to pay for annually adjusting rates. They only wanted to pay for monthly rates. And so that affects it too, right? So you're looking at somebody's statement that it's not going to go down for another 9 months. But if we refinance you, it can go down right away.
Right. Okay.
And so you're not incorrect in that. It's just complex, and different products have
Right.
different rules.
Right.
But I just don't recall. I believe there is a floor for a HECM. I just don't recall what it is. So I'll look that up and I'll email to you
Okay.
once I figure out what the floor is and bring it to the next call.
So a couple scenarios. I've got my Santa Barbara one. I'm sending out the new proposal tomorrow. I'm gonna send the application as well to my colleague out there and get that signed to lock her for the next 120 days at least. That being said, I just picked up another lead that the issue with this one, it's her husband is in hospice, expected to not make it for another week. So she really needs to get moving on this. I'm meeting with them Saturday, but she lives in a really rural area. They currently have a mortgage on the house through Zion Bank, so it's not like it's a complete off-grid type of thing, but they live in a water hauling area, and it's probably about 42 acres. So I'm gonna try to get their current loan to see, I'm hoping it's an FHA loan. So then I know it should be doable. But as far as, it's got electric to it and, that sort of thing. It's on septic, and then it's more than likely hauled water. I don't know that. I'll find out Saturday if they have a well or not, but most of them don't. So if all the houses in the area are, if it's normal to be hauling water out there and all that stuff on the forward side, it's usually okay to proceed. Other than what I'm a little bit worried about is the property size itself.
So anything over 10 acres is not going to get value. And so if the whole value is based on the lot, that value is going to be much less than they're expecting it. Typically with that, just the acreage, you can still do a reverse. It's just they only give value to 10 acres, which, makes a huge difference for people's property usually.
Okay, and that would be through the FHA appraisal. They would just basically cut off the value of 30 acres.
Yeah.
That may not
And
be that bad. I mean, when I run it on House Canary, it comes in at about 660, and they owe, I think, in the neighborhood of like 275. If everything comes in the way that it says, she's still about 25 grand short. But he's got life insurance, so we're looking at being able to go ahead and pay the shortage to get it done. But I was just, like I said, I was worried about the acreage and the water hauling. I was also told that sometimes you have to test your well water to make sure it's okay, but they say that you have to test their water source to make sure it's okay. And I didn't know if you'd run into that before.
so we have a rural section out here. And so I've done some rural. I also want to talk to Cicely because she's got a big rural property too. You guys, both of the rurals. I've never had a water hauling situation. The well does have to be tested. And if there's septic, you've got to be aware of the well being God, this is a CRMP question. The well being 50.
It's 100 feet
100?
away from the
Thank you.
septic.
Good job. So yeah, make sure that that's, and they're going to have to make sure the septic works, and you have to have all the inspections that go with that.
Right.
Just like a manufacturer has to have that engineer's report. But the water hauling, I actually just asked Elaine if she can pull up a guideline. I haven't encountered that before, so I don't know if that would actually go through the nuances of that, but I'm sure a guideline says so. You know, if there's no water, it's not unheard of to have properties like that.
Yeah, and there's literally hundreds of houses out there that are all, you know, they have hauled water, so it's just there's always that one little chink.
I would say if a normal investor doesn't, like if you run it past the normal guys that you normally would, I would check with probably Money House and see if they might be able to do it. Because again, their guidelines are just interpreted a little differently than other lenders, and they seem to be able to do more.
Okay, I'll give that a shot.
But here's the quick twist. So with those rural properties, you're coming at it going, I think this is probably the issue. And Cicely, this is for you too, what we saw in your scenario. I think this is probably the issue. And then you get the appraisal in, or the appraisal reviewed. Cicely sent in an old appraisal and said, hey, can we probably do a report? And they came back with 7 legitimate, like, these are probably going to be big problems. And it wasn't even the problem she was talking about. And so based on Cicely, based on that list, like, I don't think 14 outhouses, I don't think is going to be a very good use of your time. Might it be possible? Yeah, but at this point, yesterday I said I'd probably still try, because just the one having 7 horses on a property, probably not that big of a deal. We can probably prove the commercial use and agricultural zoning. That probably is not a big deal. 14 outhouses though.
They're out from what my realtor friend said, that they're like lean-tos for the horses, that outbuilding, not like
Yeah.
outhouses.
Oh, I see you're saying outbuilding.
Outhouse
Sorry,
is
yeah.
a whole different thing.
Sorry. Can you tell I'm not rural?
You could have a concert. You could have a concert on that property with 14
Yeah.
outhouses.
So yeah, I wasn't sure if even the Money House would touch this one with all of those.
Well, and the ADU, the biggest thing, I want you guys to all hear this too. Cicely has a property where the owner lives in the one, but then there's another ADU, but it's not necessarily just an ADU. In the previous appraisal, it called it private property, but it's a manufactured home or a modular home. And so because of that, because it's not actually foundationally fixed, that's Cicely, when I saw that, that was the killer. Because I've had properties like that where it's a big place. The parents all say, yeah, bring a trailer and come live on our property, kids. And they don't do it in the way that FHA wants it to be done. And so the property's not a fix. They can't ignore it. They can't just say, oh, well, it's a car, because it's not. And so that's where the incompatibility comes into.
Okay, because yeah, I guess it's registered as a trailer, but it's like you said, it's really not. She lives there. The daughter lives in it. It's a mobile home. It's a true mobile home because it's not a fix. It's not attached.
Well, and then the title too, the vesting of multiple non-borrowing owners that are not the same on the 2 different, like, if you could figure out how to have that property split and just parcel off the one house, you could probably help them with the reverse, especially if you
Okay.
could parcel off the rest of the outbuildings to the other parcel.
Okay.
But short of that, that file looked real, like
I know.
7% chance of going.
After
Well, it also, if you look at a possible idea, depending on who owns the thing, if it's the daughters and she's not willing to relent, as long as it's a regular mobile, that could be affixed to the property. Then it's no longer a mobile. It's no longer or personal property. It becomes real property along with the rest of it. But then the value belongs with the actual property. So depending on if she's like the only heir, then who cares? You're going to get it anyway. So that's another thing to possibly look at is the fixture of that. That
Yeah,
way she's
well-
getting rid, it no longer is it registered as a trailer. Now it's real property. So that's another one that you might look at.
Right. Well, there's two daughters and the daughters want to be on the title. So that way they don't have to deal with probate things later, which I already talked about that I need to talk to them. Like you don't have to be on title. And somebody else said that if they are on title with a reverse, then they don't have the option of buying it at 95% of value if things go down. And yes, the living trust, like Angela and Dennis said, there's just so much going on with this property, and I don't think that they want to actually affix that mobile home, because then they're going to be property taxes on that, right? And I'm pretty sure they don't want that. So
Well,
And it's-
generally, personal property taxes are usually way more than property tax, at least here. I don't know
Yeah.
about over there.
I don't know, and probably not so much here. The one thing, so it's all because she's a realtor, so she's like, oh, they just don't understand the property, but it's FHA rules that are the stoppers on all of this, not so much because they did a refi in 19, and she did say it was hard to get through, but it wasn't an FHA refi. It's conventional.
Yeah.
Doesn't FHA, Christina, have I forget what, their little hubs?
Oh, the Hawks, the Santa Fe Hawks.
Yeah, because you could kind of run the scenario by a hawk, and they can probably give you guidance on that.
For reverse.
Yeah, you could. She's already run the previous appraisal by a couple lenders, and they gave back like 4 lenders. Yeah, they gave back a bunch of bullet points of like, well, if it's not this, that's going to go wrong with this one, it's going to be this. And if it's not this one, it's going to be this. But you're right. I mean, the only thing
But
about
the
a hawk is
since it's such a crazy animal, and like the lady said, they did get financing before, so it looks like, maybe with some hawk guidance, she could come back with what the hawk said,
yeah.
and that might make the deal go fly.
Yeah. All right. It looks like Elaine's got some info for us. Go ahead.
Well,
Okay, so with the water hauling, there is a lot of debate. I couldn't find anything in the FHA, but on an appraiser website, it's going to depend a lot on if this is a generally accepted thing in this area that there's water hauling. The overwhelming consensus seems to be no, because if there's no other, if there's exclusively water hauling and there's no other source of water, then it's not insurable. But it sounded like there might be a well and they're water hauling in addition. So a cistern itself is not necessarily a no, but water hauling with no, with no other source of water might be a no, unless it's, in a clause. Like I found one small area in Arizona where this is allowed.
Yeah, with both of these, the decision kind of is, might it be possible? Maybe, but the way to find out if it's possible is to make sure the client's aware, send them to counseling, get the appraisal, do the full file, get it into underwriting. Because reverse is so much gray area. Like Cicely, even you just experienced this, right? Hey, we have an appraisal on hand. Can we do this? And there's still like, well, I don't know, maybe. Probably not, but maybe.
yeah. And
so that guideline, same.
the question I had is, because of all of the outbuildings, that's why they're saying it's over 49% commercial use. Is that what their reasoning is? Like, why does it matter how many buildings are on it?
Yeah, I'm not sure that's the reasoning, because they also listed that this particular ranch, like somebody looked it up, that particular ranch name is associated with that property address. And so that may be contributing to why they're saying it's over 49%, because there's some sort of listing online calling it a commercial use property. you know,
Well, yeah,
come,
if you look it up on Google, it says Broken Spoke Ranch or whatever, but
I
what
had
if I called
one,
my house a ranch? Like,
well, I had one that was Airbnb-ing an outbuilding, an ADU, and we could never convince the lenders that she wasn't. She had stopped. Turned
oh,
in the
really?
account. We had all the paperwork. We showed all the paperwork, and they still were like, "Nope, we don't believe you. We're not doing this loan."
Okay.
So, like, I see what you're saying, and again, is there a chance?
And
Yeah.
it might not be worth the work though to go through all that time and money on the buyer or borrower.
If you go through it, you need to make sure the borrower understands, like, hey, there's a big risk here. This is not going to go through. Do you want to give it a shot? Because if we don't try, the answer is always no. But if we try, the answer might be a whole lot of headache and still maybe no.
Right.
And, you know, some people will go through with that. I've had clients who explained that to them and said, I don't think there's a good chance, but, and then the file went through. And then I've had one or two that didn't, you know?
Is there a backup plan B? Like if you did take on the work and you couldn't do the reverse, is there some form of traditional lending that, you know,
Well,
can
I
work
think
out as a plan B, so that if you do take on the work, there's still a loan there, there's still a file, there's still a deal there.
she was wanting to do the reverse to just get rid of his mortgage payment to help him in his retirement. It's not, I don't think it's out of need. He has quite a bit of income, honestly, already, but she just thought to help him out so he's not making that house payment while he's still here.
If I were you, I would nail that down and just say, you know what, or kind of go back to, you know, this is not a typical property.
And she knows that for sure.
Yeah. So as you know, then, you know, this is not a typical property. So I just wanted to know too, I might be able to do this and maybe like play with a traditional scenario and see if it does anything. Does it save him any money? Does it do anything, you know, or is he at the best rate where he's at right now?
Wow. He refied in 19, and I guess they went with some lender out of Oklahoma. I mean, I don't even like went straight to a bank or something because of the uniqueness of this property. So I don't know that it's with the rates the way they are now. I don't know that I really could do anything better because I think he's at 3.5 or 4% something. So
yeah, that was my question. I didn't know. That's what I was saying. I mean, but you know, if you're going to take it on, you know that you're doing a lot of work. I do like Christina's creativity about parceling the property. That might be the.
well, it's weird on the, I had my title rep look it up and there are 2 parcels, but it's very, one is like land and one is developed. I don't know. It's such a weird thing. But then my realtor, she says it's only 1 parcel. I don't know. It's very strange. And I don't know how much work I want to, I don't know if it's really almost like 99%, I'm not going to get it done. Do I want to keep diving into all of this?
And that's a personal question. You know, I've taken on files where I'm like, oh my God, this is such a hairy mess. It's going to be a great experience. I'm going to
Yeah.
learn so much. I don't care that the file's not going to pay anything, you know, but then I've had other times in my career where I'm like, I have 800 clients waiting. Why am I going to waste so many hours on this one that's not going to go through?
Mm-hmm.
So
Yeah,
that's a personal.
Wish I had 800. I have another mobile home in Arizona. Oh my gosh, but there's like 7 or 8 people that live in there. What is the cap for, and I was going to look it up today, I haven't yet. What's the cap for how many people can live in the house or what the income has to be per?
So for the reverse mortgage,
Yeah.
I don't think there is a cap, but I know each state has a cap on number of people per bedrooms.
Okay.
So I don't know if they would actually enforce that, but all you would need to do, like 7 or 8 people, not a big problem, just a hairy mess. You got to get their IDs, their income, run their credit, make sure you can prove that their income takes care of their credit so you can lower the family size back down to just the couple or the borrower, if it's possible. If it's not possible, then they've got to make enough income that they can cover all 7 family size.
Mm-hmm. Well, I know that the 2 that would be eligible for the reverse, they make about 4,000, and then the daughter-in-law works and makes whatever she makes. And then it's
Are
some
they all on
lady,
title?
huh?
Are they all on title?
No, just
Well,
the
then-
two eligible.
I wouldn't bring all those people into the equation. I would just deal
I
with
don't know
the.
how you hide that in a in a mobile
Well,
home.
you're entitled to have people staying at home. I mean, who's gonna tell you that? Who's gonna say, "Oh, there's 10 people in there"? Who's gonna say that?
Well,
Um,
you're getting into the area of like our fiduciary duty. So if Cicely
Yeah.
does know, she should be forthright and say it.
But you're allowed to have people stay in your home. You don't have to report who's staying. I mean, are they renting to her? Are they renting space? Are they paying her rental income?
No.
So,
But
so
Yeah,
I mean,
I think it only applies in USDA loans, maybe.
yeah, I don't
Um,
think you need to
I-
report
I
that.
don't
It's
think
the
it's
two,
any of
the two
their-
owners. You're getting too hairy.
I don't think it's any of their business.
Yeah, it's not their business. You're violating. I mean, no.
Guys,
Yeah.
that's gray area. It's our
Well.
job to be forthright. And there's a difference between somebody staying there
But even if
and
you're
somebody
being
living there.
forthright, you can have family members live with you. That doesn't mean that they have to be part of the loan. They're not on the title. I mean, you
No,
can be
no, no.
forthright.
No, I'm
Absolutely.
just talking about your family size,
Yeah.
that part.
Oh, okay. Family
Yeah,
size.
Because
Okay.
what'll happen is if they don't tell you,
I got you, got
we've had this, right? They don't tell you the other people live in the property. The appraisal comes back and the rooms look lived in. And the underwriter goes, okay, guys, what the heck? And then now you're on defense the rest of the file. So if it's very obviously lived in, then it's easier to just get ahead of it.
It's pretty doubtful, though. The appraiser's not going to give judgment to that. I mean, it's
No, the
because
underwriter does.
The underwriter, when they see the pictures,
I mean, there's a chance she could not have that happen, that some underwriter might not even really look, but I've had it happen on my files where I didn't know about other people living the property and there were, and then we had to deal with it. And it's like,
Well, in my 20 years of doing it, I've never had it as a problem, ever.
did you ever have 8 people living in a mobile home?
I've had some interesting family setups, and it's never come up. But like I hear what Christina's saying too. I just, I don't know. I don't know. I'll
Do they
just
have any
be praying.
school-age children in this house?
Say that again, Elaine?
Do they have any school-age children in this house? Then
3.
likely their living situation has already been reported. We have a multi-generational living situation. I live with my parents. My daughter's still in high school. And it blows me away that every year I have to reaffirm that it's a multi-generational family and list everyone. Why do they need to know this information? I don't know. But they do require it to enroll every year, and they do somebody looks to see who the house is titled in.
yeah. And then what could happen in this arena is LexisNexis, right? Our underwriters use tools that we don't have access to look up things that we don't know they have access to. And they find weird things like that. That's a really good point, Elaine. I didn't think about that.
Yeah, my worry is like, even though it's like a double wide, I mean, having 2, 3, and 8 people, 3 school-age kids and 5 adults in a mobile home. It's not like you can hide that very easily, because I think a friend of theirs is staying in the living room. I mean, it's crazy. I don't know how I attract these people.
Well, I hope you can help them.
I hope so. Yeah.
And like
Sounds
Erica's
the
saying,
help
like,
they need is to get some of these people out of their home.
Yes. She needs to quit being so not to kick your kids to the side, but
yeah.
I don't know.
All right, you guys. Well,
Thank
we
you.
are at the end of our call. Thank you for making an awesome call, everybody. Go out there and get good loans.
Thank you.
Thank you, guys. Bye.